Hello, my name is Kevin Hollifield, and in this module, based around evaluating market effects, I chose the topic of interest rates. Interest rates are the central function of any finance system, and interest rates are also just literally the price of borrowing and using someone's money, such as a lending service or a bank. And when you deposit money into your own bank savings account, your bank pays you interest for letting them use your money until you decide to withdraw from this account. It's typically pretty low money that you can earn. However, it's still money that you can earn, so it's smart to look around at different banks and see what they're offering. There are a few different concepts that go into the topic of interest rates as a whole. One is the effective annual rate, or annual percentage yield. This is the total amount of interest that will be earned at the end of 1 year. Another important topic to consider when looking at interest rates are the annual percentage rates, or APR, which is something we've all heard pretty regularly, and these indicate the amount of interest earned in 1 year without the effect of compounding. I included an example here of the effective annual rate. Again, the effective annual rate, or annual percentage yield, is the total amount of interest that will be earned at the end of 1 year. So in this equation, pulled from the text, the R in the equation represents the time value of money, and the discount rate in that time value of money calculated. So in this example, the effective annual rate of 5% is showing what a $100 investment would grow to. So you have your $100 investment along with your discount rate and the time value, with the EAR of 5%. So after 1 year, you would have grown that $100 investment to $105. When applying this in real-world professions at an entry level, it's very important to understand this concept. It most likely affects your life in a big way in the form of student loans. So understanding what you're actually being charged in terms of the interest rate is gonna be very important in getting those paid off. As a mid-level professional, it's possible that you still have maybe student loans or credit card debt or something of that nature. So it's still important to understand at that level. But if in addition, if you work for a finance company that offers loans, you're going to be responsible for underwriting those deals, which you would need to have a sound knowledge of interest rates at that point. And executive level would be the same as a mid-level professional. They're going to be very in tune with this, especially if they're involved in a company that offers some sort of loan. In the terms of ethics when relating to interest rates, I think that ethical issues can arise when companies charge a very high interest rate to those who need a certain product or just a loan. So it could be, an automobile to get to work, to make money, to get their kids to and from school, or just getting a loan to pay bills to get by. These interest rates, when dealing in higher risk type loans with people with poor credit or maybe have a bankruptcy. It makes it harder for these people to pay back these loans, and can possibly hurt their credit more over time. So I know there are laws based around the how much a company can charge in interest, and that varies from state to state. I think it probably maxes out around maybe like 20 something percent, low 20%, which is still pretty significant. And with that, I found a verse in Proverbs that I think applies to this, and it reads, "The greedy bring ruin to their households, but the one who hates bribes will live." And I think this is just, I think companies should be mindful. I understand they want to make money, but making sure they're setting up their customers for success, making sure they are able to pay back the loans, I think is important and ethical when dealing in this topic. Again, this was over interest rates. I used the text provided as well as the Bible for the Proverbs verse. And thanks for listening.